Welcome to our March webinar. I'm your host, Nathan Bell, and Director of Research, and today I'm joined by our Chief Investment Officer, Wayne Peters. Welcome, Wayne.
Yeah, good morning, Nathan.
So just a couple of quick notes before we get into it. We'll try and keep the formal part of the webinar to 20 minutes, and then we'll have questions afterwards. We've already had plenty of questions submitted, but if you would like to submit any questions, please do so either now or through the webinar, and we'll do our best to answer them. And I just want to mention something up front because I'll probably forget at the end. We've introduced a podcast. It's published fortnightly. We've got 3 up so far. They range from 15 to 20 minutes to half an hour. And they're about companies and industries that we are invested in, but they're also about some stocks and investment topics that we discuss broadly or aren't investing in. And it just gives us more time to go into more detail. So that will suit some people and not others. But we just wanted to mention that's also there. So I'll assume the disclaimer is read. As always, I just wanted to highlight what we're doing at Peters MacGregor, because always we want to bring things back to first principles. We're founded in 1999 and we're searching the globe for great business to own for the long term. We're independently owned and operated. The portfolio tends to have 20 to 30 holdings, but we tend to be in the low 20s, and we're aiming for 10% annualized returns. Where are we finding safe opportunities in the current market and just generally? We've had a lot of success more recently finding value in complex ownership structures. For those familiar, that's some of the Liberty names which we're going to talk about later. It's not that the businesses themselves are complicated, but rather just the way we've actually been able to find more value in holding structures by pulling apart their underlying earnings, which a lot of people don't like to do because it's complicated and hard work. But it's been worth it for us finding the value there. Second part there is founder-led companies. If you have a look at the research, this continues to be, even in a hyper-competitive world, one of the most reliable ways of outperforming the market over time. And 3, something that will never change as long as humans are in market, there's an advantage to be focusing on the long term. I think the average holding period now is down to days or maybe weeks compared to years in the past. And just the whole idea of delayed gratification doesn't really work for most people in the digital world. So if you can be thinking 1, 2, 3, and 4 years ahead, that's really where you're going to find a lot less competition when you're buying securities. Just the performance there, nothing too new to highlight other than the 1 year looks quite weak. There's a couple of reasons for that. One, I would just say if you're following a bunch of value investors at this point in the cycle, you probably wouldn't be expecting them to outperform in any case. If they are, they're either taking a lot of risk or they're not true value investors. And the second part is that our biggest holdings really haven't done anything for us share price-wise over the last 12 months. So we thought we'd use this opportunity to explain about a couple in particular that are 2 of our 3 biggest holdings, why we own them and why we're sticking with them. Just on the portfolio exposure, one thing I will highlight, there hasn't been a lot of change here since our last webinar in November, but there is going to be a change in the future. You can see the large consumer discretionary exposure there. That holds all our internet providers, and as I always joke, I struggle to ask any parent to tell their kids that having the internet is a discretionary item these days. The reason we own them is because internet is as vital as electricity or gas or any other utility you have. So to have them in consumer discretionary doesn't make a lot of sense. And it finally seems that the index providers have also agreed with that. So at some stage in the future, you'll see a new segment called communications, which will house our internet providers. Just wanted to make this point because it ties in very much with the performance numbers. We're now basically at a record point where this has been the longest stretch in history where growth stocks have outperformed value stocks. And we've got a number of questions around what's going to happen with higher interest rates and things like this. But the bottom line is a more volatile market with lots more stocks going up and down gives us a lot more opportunities to buy low and sell high. So while a lot of people are worried about more volatility, and I think by that what people really mean is they're more worried about just lower share prices. For us, it's a period where we're actually really looking forward to that because these hard momentum-driven markets make it very hard to find value, and we're finding enough, but our job becomes a lot easier and much more interesting when the market starts to get more volatile. So this has been a record stretch, and we're very much looking forward to a turn at some point. Portfolio changes since our last webinar in November. We've exited Berkshire Hathaway and Tencent purely on valuation grounds. Tencent we still own by de facto through our holding in Naspers, and it's one of our larger positions. And in terms of new additions, there's Discovery Communications, which I'll ask Wayne to talk about in a minute. And the other one there is KT Corp, which is the largest South Korean internet provider. We think it's absolutely dirt cheap, but I'm not going to talk about it in detail today. We'll wait for the quarterly and we'll do a proper job of writing it up. We've got a bit more time. So with that, Wayne, we discussed Discovery in our last quarterly, but it's worth just reiterating the investment case.
Yes, Nathan. Discovery is now one of our largest positions. Most people would know it from the various channels that it operates. Discovery, Animal Planet, and just last month it settled the acquisition of Scripps, which has the Home Cooking Network. It owns the Oprah Winfrey Network and a host of other pay TV channels. This acquisition will make it now the largest provider in the world of what's classified as non-scripted content, compared to channels like Netflix, which are all about shows and what they call scripted content. The beauty about this business is their fees that they obtain on a channel-by-channel basis or in packages are one of the lowest, and there's significant room for upside in the fees that they can charge for that content, we believe. Of course, the entire industry is in transition, and the content providers as well as the cable operators have come under a lot of pressure, and hence we believe this has given us the opportunity to buy at significant undervaluations, because the market seems to be very focused on cord cutting, and we'll dive into that theme a bit more when we discuss the Charter investment in our portfolio. But this cord cutting, we believe, is being significantly outweighed by the increase in internet usage and the ability for a content provider such as Discovery to transition. And our investment case hinges primarily on the ability for Discovery to transition to different channels for its fee generation, primarily through over-the-top, let's call it offerings, and offerings through a broader array than just the traditional cable network. This stock is selling at a very, very cheap price. The forward 12-month estimate is a PE multiple of about 8, and a free cash flow yield, Nathan, of about 15%. And in a world of low interest rates, and in Europe even negative interest rates, we think this is a phenomenal buy. But of course, our time horizon is 5 to 10 years, and we expect, we have no idea how this plays out over the next 6 to 12 months. But at this price, and as a long-term investor, we think we're going to earn very, very significant returns from this investment. And of course, this business has also the hand of John Malone, so the management caliber is one of the highest that you'll find. So it plays to our theme of investing with strong founder and owners that have a large amount of skin in the game. We've always found, and research shows, that the returns from such companies are generally much higher than the average. So our expectation for this position is very, very significant.
The research shows that I think it's around 70% or higher of takeovers and acquisitions don't add any value, but on the numbers we're seeing at the moment, there's just enormous, I hate to use the word jargon, but the synergies is, I think, $350 million in cost savings alone to come out of the two businesses. You've got no need for two sales forces, and if it can also give the business increased negotiating power with advertisers, and also with the cable companies, then this should be an extraordinary cash cow in the years ahead.
Well, I might just add, I mean, discussions with the CFO last week indicated, and he mentioned it 3 times, and the CEO mentioned it twice, that their expectation of the synergies from this merger will be easily met. The merger was announced in July of last year, and from what we can tell and the communications we've had with the company, they've been acting as if the merger had happened back in July. They have done everything to hit the ground running on completion of the merger last week, and the new executive changes, all those announcements were made pre-settlement, and as the CEO mentioned, Discovery has 600 sales representatives, and Scripps had 500. Now the salespeople will be able to just take a much broader portfolio and glean much more interest with a broader portfolio from their existing customer base. And we would expect that around half the total number of sales representatives won't be necessary as an example. Plus there's going to be increased revenue opportunities by having less competition, a broader portfolio, and where we just think the management's targets are very conservative. And frankly, given that they have such a large investment themselves in this business, there's no incentives for them to overpromise. And our experiences with the Malone companies is generally they underpromise and work very, very ferociously to overdeliver. And that's what we expect here.
It's probably also just quickly pointing out that half of Discovery's business is in Europe, and it's not facing anywhere near the cord-cutting pressure that we're seeing in the US, mainly because the cable TV bills are much smaller in Europe and have less of a history than what they do in the US.
Yeah, that's a very good point, Nathan. They own the Eurosport channel and Dplay Sports channel in Europe, and they secured the broadcasting rights to Europe for the Winter Olympics over an 8-year contract. And the first of those Olympics has just played out. Their subscriber numbers have gone from 1 million pre the Winter Olympics to 1.5 million. So they obtained 500,000 additional subscribers in the weeks leading up to the Winter Olympics. So, just a phenomenal growth, and, we're very, very excited about the prospects there.
So I've just flicked across to the next slide. Where are we finding value? So these are the same 3 themes that have dominated the portfolio for the last 12 or 18 months. Not real any big updates on the European banks. I think the main thing that's really going to be the trigger for much higher valuations across Europe is going to be higher interest rates, and we might cover that in the questions too, where people are asking about the impact of higher US interest rates. Chinese technology stocks are just humming along, and we're about to get into some of our internet providers. So our internet companies are a couple of our biggest positions. We're going to talk about 2 in particular. One is our de facto holding in Charter Communications, which is the second largest US cable TV and internet provider in the US. And then I'll get Wayne to talk about that, and I'll talk about Liberty LiLAC, which is a fully spun off company with operations in Latin America. But just to come back, we don't own the big US technology companies, but in a sense we are actually benefiting from these companies being there. The last statistic I saw was that 54% of all internet traffic is from YouTube and Netflix alone. So essentially what we're doing here is, in the old days they talked about rather than investing in the gold mines, it was much more profitable to sell the picks and shovels to the miners. And essentially that's what we're doing by owning the digital highways for these companies. Essentially we get a clip of the ticket every time people are using the internet. So you can see on this slide here the growing internet usage worldwide. It's growing very quickly, and it's going to continue to grow very quickly. If you're looking at places like India, which is only really just starting to grasp what the potential is there, it's going to have more mobile phones. There's going to be more mobile phones in India soon than what there is anywhere else in the world. And again, the mobile phone, this digital revolution, all hinges on owning the internet infrastructure. And so that's what we've been buying in places around the world. And I'll just say quickly, I just remember in 2000 sitting in London, and the telecommunications companies were all trading on nosebleed valuations. This was a time where the tech boom was really taking off. You're somewhere near the peak. And back then, the companies were all bidding for what they thought was hard to get spectrum. And I remember them bidding billions of pounds and around the world, other companies were doing the same thing. And everyone thought the telecommunications companies were going to be the dominate the markets for the next 10 or 20 years for internet. And what actually happened through the tech wreck was it found out that everyone had overpaid. And one of the worst sectors to have been in the last since then, so 17 or 18 years, has been the telecoms industries. And the reason is because mobile phone prices for your annual bill have been going down. People have stopped using their phones at home. They've been spending billions and billions of dollars on their networks, but the price competition has made those investments not necessarily redundant, but the returns have been very poor. And if we look at some of the places like America, it's the cable TV companies with the pipes in the ground that have been the big beneficiaries of providing the backbone of the internet. So it's been this terrible place, but what we're actually finding now is that these stocks are so beaten down that the market's just thrown them away. And KT is a classic example, which again, we're not going to go into detail today, but it just looks so cheap on the numbers, and they've got growing internet businesses. So the point is the cycle's really come full circle over 2 decades, and we're finding a lot of value in this area. Again, just on the next slide, it just shows you, people always ask, what about if there's a technological change when we're about to switch into 5G? But regardless of what, no one actually knows what 5G is going to look like at the moment. It's actually very complicated. But even if we move into that world, particularly in these countries like the US and Latin America, where they have their historic cable TV industries with the pipes in the ground, they're still the fastest and cheapest and most effective way to deliver internet to the house is still through these existing cable networks. And that's not going to change with 5G. And in fact, we might even talk about this, but Charter Communications, as big as it is, we've had about 4 or 5 different companies looking to take it over because those pipes are so valuable. So with that, Wayne, I'll just get you to talk about Charter being, through a combination of holdings, it's our single biggest holding. It really hasn't added much to our performance over the last 12 months, but just reiterate the case for the company.
Yes. Well, we like Charter as much as when we first invested in the business. The exposure we have is via our Liberty Broadband position, which owns 22% of Charter. But by buying Liberty Broadband, you're obtaining the investment in Charter at an additional 15% discount. Our assessment of our price to value, i.e. our discount to our valuation, is around the 40% to the investment in Charter. So Liberty Broadband owns a controlling stake of about 22%. And then our other investment, which has a slightly larger margin of safety, is through Liberty Ventures, which has only recently changed its name to GCI Liberty. And it has just over 2% interest, a direct interest in Charter, plus it has other assets. So again, using additional research and working through the somewhat more complex holding structures, we're able to obtain these fabulous assets at a much larger discount. And as value investors, that's what we're on about. So coming back to Charter, it has in Rutledge the best CEO recognised worldwide in the cable industry running the business. And after the recent acquisition of Time Warner Cable, and Bright House is now the second largest cable operator in North America. It's the third largest pay TV operator. And of course, these businesses came under a lot of pressure as the word spread that cord cutting was going to increase. To put that in perspective, the last 12 months, you've seen the reduction in cable subscriptions in the order of about 1.5%. So it's not like the subscribers are falling off a cliff. And what's interesting is because cable happens to be the quickest and cheapest way to offer fast, reliable internet, people, once they cut their cord, need to have, high, consistent, quality internet, because they still want to watch content, and if they want to use a Netflix or want to go direct to Disney or Apple TV, then they need high, consistent internet, and cable happens to be able to offer that. So the revenue in total and per user has actually gone up, even though you're witnessing the number of cable subscribers decreasing. So that was our thesis coming in, and that's exactly how we're seeing the game play out. These are highly cash generative businesses, and another feature that we like a lot about them is they've really become a utility. So they're very lowly correlated with economic cycles, because just like your electricity or your water supply, once you're used to having internet, you will forego pretty much everything else before you'll cut your internet service provider. And so here we have a utility-like business with utility-like margins, growing on average very strongly, and run by the best CEO in the business. And what we like about it, and you can see this on the map of the USA, is Charter now has a very wide footprint after acquiring Time Warner and Bright House, and Rutledge is only a very small way through transitioning that acquisition and bringing everyone onto the same platform. The brand name is called Spectrum, and so if you're in the US and you're a subscriber, Spectrum is the name of the company and the brand that you're dealing with. And of course, there are always legacy issues. Time Warner ran a very poor operation as far as how it ran its subscription model, and of course Rutledge has to clean that up. So they will be losing a certain number of subscribers that weren't paying the appropriate fees, but on average we're seeing revenues head north, which is what we expect. So within 5 to 10 years we think we're going to earn a lot of money from our investment here. But as Nathan mentioned, if you look at the communications industry and index broadly, and cable in particular, in the last 12 months, where the markets, the general market indexes have grown very strongly, albeit in a very narrow range, the communications index didn't play along. And so this is the main reason that we underperformed in the last 12 months. But we just don't know how to play that short-term game. We're about buying businesses for the long term, switching the short-term noise off, and buying investments at a significant discount to what we think they are worth over the long term. And we draw comfort from the fact that we know if we own these 5 and 10 years out, we're going to be much richer than we are today.
So just in the interest of time, I'll keep the Liberty Latin American part short. So all the same things that Wayne's talked about apply here. The main difference is just the background of how this investment came about. Liberty LiLAC used to be part of Liberty Global, which is a $40 billion business, so a very big business. LiLAC is the spin-off. It's been orphaned. It's only about a $4 billion business. And it admitted about 18 months ago, or about a year ago, overpaying for an acquisition. And then it's also recently been hit by the hurricanes in Puerto Rico. So Liberty Latin America, about 5% of its business is related to Puerto Rico. So this is a business that did have a share price of around $40 not all that long ago. It's currently around $21. And it's being priced as though it's a mature telecommunications company with very little growth, and all it can do is pay out a high dividend. And the business is nothing like that. It doesn't pay out a dividend. It's actually got huge growth opportunities, one by expanding its networks across Latin America. It operates in regulatory friendly countries where the countries themselves don't want to use the government budgets to build these very costly internet infrastructure networks. Liberty can do that. And internet usage rates, or fast broadband internet speeds, the usage rates are only about half in most of these countries compared to developed nations like Australia and the US. So there's an enormous growth runway for this business, But at the moment, it's just having to deal with a couple of these short-term issues. And once that goes away, we should expect this to be the fast-growing business that it ought to be. And then, so one, we'll get the benefit of the growth as it comes through, but also we should see the valuation go to something much closer to a Charter Communications rather than a fuddy-duddy old telecommunications business which isn't growing. So that's the scenario with LiLAC. So basically, we spent today talking about our three biggest positions. The fact that they just haven't done, Discovery's helped, but the other two just haven't done a lot in the last 12 months. But we like these businesses as much today as we did since we bought them, but we just don't know when the market's going to agree with our valuations. So just before we go through the questions, we'll just sign off. A few things to note, and there's nothing new in here. Higher interest rates and increased volatility will favour value investors. There's a question about that we'll talk to in a minute. We're trying to invest in beneficiaries or companies whose valuations will compound at high rates regardless of economic fluctuations. So again, these cable companies are the digital highways, and regardless of what the macroeconomic environment looks like, we know people are going to use these services. And we're still trying to stick to reliable and tested ways to beat the market over time. And spin-offs are one of those. So we just talked about Liberty LiLAC, looking for higher insider ownership. And I don't think you'll find another portfolio out there that has as much insider ownership across the portfolio as ours. And we're looking for high quality businesses that are misunderstood with low valuations. And our investments in Liberty Broadband and GCI are good examples of those complex holding structures that we think are undervalued because they're not as well understood as what we think they are. And again, we've been around for a long time now. We'll have 20 years up next year. So we've got a repeatable process that we know works through multiple cycles. So with that, we're going to switch into the questions. I'll take the first one. What effect will rising US interest rates have on company value and growth over the next 12 months? When I was at university, I did economics, and I was told that when you change the interest rate, it would take 12 to 24 months before that would actually impact the economy. But I think the way the world works today is that that transition doesn't really take that long. That said, I'm just not convinced that these short-term movements, so the Fed's saying basically looking for a 25 basis point increase each quarter. I don't think that's necessarily going to have an impact over the next 12 months. I think the bigger issue is more about what happens in 1 or 2 years when you start getting potentially get a longer-term interest rate. So this is in the bond market now. When you start getting to 4 or 5%, we're just in a world that's far more leveraged than it's ever been. But at the moment, interest rates by historical standards are very low. We're seeing in the US that millennials are starting to buy homes now. So I just don't think moving the short part of the curve from, say, 1.75% today to 2.75% in 12 months is necessarily going to knock the market around. But if you look at our valuations, we continue to use our 10% discount rate, so it's not going to impact our valuations.
Okay, I'll jump into the second question here. Interested in our view on how Berkshire Hathaway will deploy cash reserves in a current volatile market environment. Well, I'll just pick up on that latter point. We haven't really, my observations over the last few years is we've been in an environment where we've had extremely low volatility. The market has seemed to move only in one direction. And then, of course, we have a month like February where you see a bit of, a slight spike in the volatility, and then it quickly bounces back. And the headlines you read on every paper is, volatility is back with a vengeance and so forth. I just don't see it. A 5% movement, it has generally been typical. You've typically seen that every 6 months or so. We've gone almost 3 years and we haven't seen anything like it. So the recent environment has been marked by extraordinarily low volatility. And as a value investor, we relish the day where we start to see high volatility. We've not seen that yet. The price movements in February saw the prices of many of the companies that we're interested still be higher than where they were in December. We weren't jumping up and down in December, so we certainly weren't jumping up and down in February. A large market correction is something that we would relish because that would allow us to put our additional cash to work. and build through that long-term value for our existing investors.
And just talk about Berkshire Hathaway.
And so moving now to Berkshire. Berkshire has built its cash position. It's currently sitting on just on 100 billion in US dollars. But this is a company that's worth greater than 500 billion. So in essence, it's sitting on about 20% cash. Its preference is to invest those in wholly owned businesses. And so they are definitely looking for what Buffett calls elephant acquisitions. Acquisitions in the $5 to $10 million range just don't move the needle anymore at Berkshire. So although there's probably greater opportunity in that area, which is where we're fishing, it really is a waste of time for Berkshire to be spending its time there. So what we do know with Berkshire is they're extremely rational, and that cash will be deployed once the opportunities arise.
I'll just read out the last one. You can answer, Wayne. You have moved from being able to hold decent amounts of cash if there was no value in the market to having to be more fully invested. Why? I preferred the previous model.
Yeah, well, it hasn't been a wholesale change. We've moved our cash limit from 30% down to 20%, and we're currently running about 9% cash in the portfolio. As any business, you're always looking to make improvements and look at where you've made mistakes in the past. Our biggest mistake in the last 5+ years has been that we've carried too much cash. And as you know, Nathan, we don't target cash as a particular weight. It's simply a byproduct of us finding opportunities. Our stock picking ability has been just fine. Our strike rate is 76% over an 18-year period and through multiple cycles. So we certainly know how to pick the right stocks. The mistake we've made over the last 5 years is we've been somewhat too cautious, and we haven't backed our stock picks with as high conviction as we should have. And that has cost us about 5% a year. So it's been a very costly mistake. The minor moderation that we've done now, instead of making a position 3%, for example, we've made them 4%. So it's a modest change, and we hope it's an improvement. And it's just basically kept us more focused on the ideas that we're looking for. So I think that pretty much sums it up.
So just asking for our comments around the portfolio behaviour and changes further to the recent market correction. The first thing I'd say is there were pretty small down movements in February. So I mean, personally, I barely even notice these things, but I know they're important to a lot of you and a lot of your clients as well. But I think we were just slightly under what the market did. But I think the most important thing is that we can even just see through the questions we're getting now in all different sorts of areas is people are worried about the volatility, and what that's really code for is that people are worried about falling valuations and falling share prices. But the number one way that we preserve capital, if you look through our portfolio, the companies that we own are generally the number 1 or 2 in their industry. They're absolutely first-class businesses that dominate their industries. And sometimes, for whatever reason, they may be more volatile than the market in a down market or through a volatile period. But it's always important to remember that volatility isn't the same as potentially losing capital. And that's what we focus on. And it's very easy to say that, but it's very different when you actually go through a proper downturn to believe that. And I think the reason we have a lot more confidence going into those down periods, and I think what investors do generally, is just the fact of how much time we spent on the business and how well we know them and how well we know the managers and what they're going to do during those periods. And what you should expect from good companies, particularly the leaders in their industries during any downturn, is that they take advantage of it. So when most of the weaker players are worried about a weak balance sheet or raising capital, the strong players are actually worried about taking their customers or buying back shares at low prices. And that is exactly what we would expect to see from most of the businesses that we own. There are definitely a couple of businesses that aren't number 1 in their industry, but we still own them for particular reasons. But when I think about how we protect capital, the number 1 way is we're just buying excellent businesses. And some of you may have heard me say before, I thought one of the most disappointing aspects of the GFC was because essentially the global economy got rescued, and I probably agree that it did have to be rescued. A lot of businesses that should have went out of business for poor management decisions or because they're weak businesses and had too much debt, they didn't actually go out of business at all. So what actually happened was you didn't get the benefit of holding the strong hands through that period. And in fact, it actually worked quite the opposite, where if you had bought the weaker hands because they essentially got rescued, you actually did much better coming out of the GFC owning those names than you did buying the high quality names. So in a sense, you didn't get rewarded for owning the high quality, but the way we think about protecting capital is just to buy those businesses that are absolutely unshakable from their market positions, and that they're investing heavily to make sure their competitors can't compete strongly against them. And we've talked about the broadband and the internet companies today. Again, they're all the number one or number two in their relevant markets. And we talked about Google a year ago or more trying to compete with Charter by laying fibre, and everyone got very worried, and we get the questions about the new technology and what's Google going to do. And then within 1 month after all those questions came out, it gave up. It was just far too expensive to dig up people's sidewalks and the roads to put all this fibre in the ground. So these internet companies that we own are in some respects, monopolies. It's not like in Australia where you've got a lot of different internet providers to choose from. You've really only got these one guy, and if you give up your cable TV, then you're just going to get charged more for your internet when you watch Netflix. So the next one is, what other US industries are vulnerable to Trump's tariffs? I'll just take this one very quickly. To me, the worry is with this is it actually just creates some sort of war where it's a race to the bottom, where you just get people reacting to each other and it just goes one decision after another. And all it really does is add costs, and you get people having to spend more on things that they would rather spend their money on otherwise. Employment goes down, and it really just acts as a massive tax. In terms of what other industries might be vulnerable, all I would say is it's not impacting any of the stocks we own, and generally tariffs tend to be associated with very low quality industries, very capital intensive, people intensive businesses, and they're just not the ones we tend to own. So we are keeping abreast of these things. It's hard not to, but it's not impacting our portfolio. So and generally we actually try to steer clear of businesses that can be influenced by these sorts of things.
I'll tackle the next question. It is psychologically difficult to continue adding to investments in this market. How undervalued do you consider the current portfolio to be, and do you think it prudent for long-term investors to continue to add to their global fund holdings? Our current portfolio has a medium discount to our assessed value of just on 30%. So we think that's very, very attractive. And our valuation methods, as Nathan suggested earlier, have this, our discount rate is still 10%. We haven't lowered the hurdle as interest rates have fallen. That's certainly made it more difficult for us to find opportunities, but it's maintained our discipline and the conservative approach that we do to company valuation. So I think those aspects will certainly hold the portfolio in very strong stead moving forward. So prospectively, the portfolio looks very, very enticing in our view. This issue of timing the market, I've never seen anyone who's consistently been able to do that. In hindsight, you'll always be able to pick some people who have timed it, but in our view, that's more luck than anything else. If you've tried to time the market in the last 7 years, you've missed out on doubling or tripling your money. So the money that's left on unearned returns by trying to time market generally is much higher than going through any type of market downturn. The number one attribute that you need to be an investor in the share market is temperament. More than IQ, more than company insight, temperament is very, very important. We view the pricing mechanism of the market simply as an opportunity, if we own something, to sell at a very high price, or to buy something if it's being sold at a very low price. And in between those two decisions, we just switch off the market movements. We're focused on the businesses we own as long-term investors. If you own these businesses and they weren't listed on the stock markets around the world, your whole psychology would be different. And so whether something moves up by 5% in a day or down by 5% a day just doesn't impact our thinking at all. And having that temperament, I think, is absolutely essential to investing in the stock market. And if you're not able to do it yourself, then to get access to these high return businesses, you need to find a manager that has that right temperament. Now I'll move on to the next question. Can you describe the competitive advantages of JD versus Alibaba? These are the two Amazon-like businesses in China. We're invested in JD.com and we're not invested in Alibaba. The two main differences is that JD operates in a much more focused arena. It deals not in counterfeit products, whereas one of Alibaba's largest platforms deals predominantly in counterfeit products. And the other main aspects is that JD has a much more sophisticated and built out delivery logistics system. Delivery times at JD are measured in the hours, whereas at Alibaba it's measured in the days. And we believe that's a very significant competitive advantage. The other aspect is JD is the baby of the two, and it's growing much quicker than Alibaba, and it's selling for a lower price. So all those factors, coupled with what we believe is the standout CEO in that space, makes it a very attractive. The business is also owned, 18% of the business is owned by another holding of ours, and that's Tencent, which Nathan outlined before we own via our Naspers holding. And 10% of JD is also owned by Walmart. So JD has two very significant backers as it moves to expand its network, also into the physical store location. And one other just interesting side bit, which I think will be a very significant trend as we move forward, is delivery by drones. JD is the preeminent operator in drone technology, and generally we think about drones as being these small devices that deliver, maybe a half a kilogram package. But they have commercial drones that are delivering up to 1 ton of product, not only to their end customers, but from their suppliers into their production warehouses. And the automation levels are very, very significant. So we like JD over Alibaba at this stage in the cycle.
So next one, very quick one. Was February really a rout? What we would call a 10% plus correction? So I agree where this sentiment's coming from. No, it wasn't a rout. And I really think the media does people a disservice with the language that they use, particularly as someone who used to be a part of it. There was a headline the other day that said, I can't remember which company it was, but they were expecting Sydney or Australian property prices to tumble 4%. Now, tumbling is not 4%. It's the wrong word to be using. If you've been through the GFC period and you saw share prices just going down day after day, month after month, that was tumbling. And I think it seems to me these small moves that we have up and down on a daily or weekly basis are just getting far over-characterised, because really the market's just been going one way for so long and people want to sell newspapers. So, and again, if you just look at where we are in the context of this market, the US market's up about threefold since March 2009. So even a 10% or a 20% correction would be fairly small from where we've come from. We've got a few more questions, but this one is your views on Interactive Brokers, which I'll get you to do, Wayne, and I'll cover Cisco and ResMed.
Well, Interactive Brokers is the online broker service offering. It has just been a phenomenal business. We've watched for a long time and we've just watched it grow. Unfortunately, it always seemed expensive to us, but we're making a lot of mistakes of omission, and it's something we do think about a lot, because even though you as our investment don't get to see what we don't invest in, we view mistakes of omission as just as costly and valuable to those of mistakes of commission, where we actually do make a decision and it doesn't play out according to our thesis. Its main advantage is that it's deployed and built the best and latest software platform for delivering the ability to buy and sell shares at an extremely low cost. So it's a reinforcing circle, and we believe they've built quite a competitive moat there. And it's run by a very very motivated CEO. So we like the business a lot.
Yeah, I'll just say one of probably the main risk with Interactive Brokers is that occasionally they've had blow-ups where you've gone through, you may remember, probably was it 2 years ago now, where there was a peg, I think, between the Swiss franc and the euro, and they undid that peg. And because Interactive allows its clients to leverage up, there are some people who essentially set themselves up that they would take on all this leverage, and Interactive Brokers had to cover the cost. I think, if I remember rightly, to the tune of about $150 million. So there is that risk with the business. So far, the 2 or 3 times this has happened, it's been manageable. But again, no business is risk-free. Cisco, I can say very quickly, I looked at this a long time ago. It's just not in my wheelhouse. The best I understood it was that it essentially controls the network switches, if memory serves, and I just didn't understand the industry, how it works and what it might look like in 10 years. So Cisco was too hard for me.
Yeah, ditto for me.
And ResMed, fantastic business. I actually like Fisher & Paykel Healthcare better than ResMed. The reason is because half of its business is not just dealing with sleep apnea, but it actually deals with treating people in the hospital. And what you tend to find is the good businesses that sell products to hospitals tend to be very, very profitable. And the main reason is because Fisher & Paykel, 80% of its revenue comes from consumables. So think about the tubes and the masks and these other little bits of little devices that when you use them in a hospital situation, you can't typically you can't reuse them with another patient because you don't want to spread infection. And also these things tend to wear out or they don't fit very well, so they have to be replaced. So that's an absolutely wonderful, wonderful business. The problem with those companies at the moment is you're just getting an awful, awful price. Next question is just going back again. Thanks, Dan. Can you discuss the Brexit implications on Lloyds and ING? The main reason we own Lloyds is, again, it hasn't changed, and I just keep asking myself, am I wrong here, is that the actual profit that on an underlying basis that the company makes at the moment is somewhere in the order of £8 billion, but the actual profit that's actually available to pay out from dividends is about half that. And the reason is because it's still, even today, paying out or taking provisions for this payment protection insurance that was sold to people unwittingly prior to the GFC. So it's a huge difference in what the actual the cash the business is producing and actually is what available to pay out as dividends. And I think the dividend yield is now between 4 and 5%. But that's going to end. There's August next year is when you cannot make any more claims on PPI. Hopefully they've got it all sorted now, or maybe even at worst there's another $1 billion to go. But for a business that earns $8 billion a year, that's very small. So I'm just hoping the market, it's really just a situation if they want to see the PPI finished, see the actual reported profits the same as the underlying profits, and we'll get the proper valuation for it. As far as Brexit implications, I think a lot of companies would be not investing very heavily in at the moment just because of fears about what it's going to look like. What's happening in the economy and what a post-Brexit looks like. But the main reason we're investing in this is not anything to do with Brexit. It's just that big difference between reported and underlying profits. And ING, again, I don't think Brexit is going to swing anything for that company either way. It's a wonderful bank. I think it's very, very cheap. If interest rates go up, if interest rates don't go up, it's probably somewhere slightly cheap, maybe fair value. But I think it'll just play out like the US banks, and that is once interest rates finally start going up, that's when all of a sudden the market will get on board, because the market, again, is only tending to think 6 to 12 months ahead. That's a typical time frame for the sell-side analysts. And so when they see interest rates going up and the net interest margins will improve and the profits and dividends start increasing from already quite attractive levels, that's when you'll see the valuations re-rate.
Mm-hmm. Another question we've had in is how is it going with Metro? Metro Bank is one of our UK banks, along with Lloyds that Nathan has just discussed. Metro is one of the challenger banks. It's one of the smaller banks. Interestingly, it obtained the first banking license in England 10 years ago that had been issued in over 150 years. So that just gives you a bit of flavour of how staid and traditional the English banking system has been. Since the introduction of these challenger banks, the whole competitive landscape is changing, and Metro is definitely leading the way. Our thesis has only been reinforced since we made the investment around mid last year. The last meeting I had with Craig Donaldson, the CEO, was in September just gone in London, and the metrics which we had penciled into our investment valuation have just continued to increase. So they're executing above their stated plan and achieving success on just about every part of those metrics. So we've been very encouraged with the progress to date, but our investment nevertheless still hasn't been 12 months in that. But over the coming decade, we expect their loan portfolio to grow about tenfold. Because they have such a low market share currently, we believe that's very achievable. And this is just remaining focused on the Greater London metro area.
So that brings us to the end of the questions. Just reiterating the podcast episodes we've done so far. Wayne focused on JD, so if you're interested in that particular business, you can go back and have a listen to that. And the most recent one was Trevor talking about the cable company. So if you want to hear even more detail than what we've gave you today, then please go and have a listen. As always, thanks very much for listening. And if you have any questions, by all means, please get in contact. Thanks very much.
Thank you.